This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Doug Noland joining us this morning. Doug is a very well-recognized writer on the web and is a credit analyst. He is Senior Portfolio Manager with Federated's Alternative Equity Management Team. Welcome, Doug.
And I apologize. I have to start with a correction.
Okay.
I ended my relationship with Prudent Bear at the end of the year. After 16 years, I'm currently working independently, following the markets, following my credit analysis, and getting ready for the next chapter of my career.
Doug, where could people follow your work directly now? Do you have a website?
Yeah, I sure do. I have my blog now at creditbubblebulletin.blogspot.com, and I post my article late on Friday evenings and then update links to news stories on a daily basis just to help try to inform and educate.
Well, I know you've got a big following, so I'm sure a lot of our listeners will be glad to hear that. Doug, maybe we're here to talk about financial repression. Let's kick it off by you defining what you see it to be, what it means to you in your own words.
Sure. I probably have a somewhat unique perspective on financial repression. To me, it's just fundamental to current policy to try to sustain a global credit bubble. It's a bubble I've been following now for 25 years. The policies have become ever more desperate, especially as the credit bubble has gone global. And to me, it's just a case of policymakers distorting the incentives, especially the financial incentives. That is particularly painful for savers. Basically, policymakers want to drive money out of savings into risk markets, provide incentives for speculation, for leveraging, and all of this is to reflate the system, to generate significant credit growth. And these policies now have been going on for years, and I think that they're failing.
How much of this do you think it's a planned strategy to reduce the debt burden of the government, and how much of it's just happenstance or bad governance?
Well, I think it's flawed economic doctrine. I think it's flawed policymaking. I think it goes back a long ways. I remember sitting at a fixed income trading desk. I was a treasury analyst at Toyota down in Southern California during the 1987 stock market crash. There were worries about another depression, so the Greenspan Fed flooded the system with liquidity. Then we had the late 80s excesses. That bubble burst in the early 1990s. Then the Greenspan Fed came in and aggressively slashed interest rates, created a steep yield curve so the banks could borrow cheap and lend dear. And it seemed miraculous, except it also provided an incentive for leverage speculation. And we've been in serial booms and bubbles since then, and each bubble just gets bigger, and each post-reflationary effort is just more extraordinary and extreme policymaking. The view is that the 100-year flood was in 2008, the once-in-a-lifetime crisis. I don't believe that. I think, unfortunately, we're in a bigger bubble now. It's a global bubble. It's at the heart of money and credit. And I fear when this next bubble bursts, these different policy measures, the financial repression won't really have much of an impact, unfortunately.
This has went on much longer than I suspect you could have even imagined.
Yeah, I know. Back in the 1990s, I was obsessed with trying to understand how an impaired banking system from the early 1990s morphed into this new-aged financial system that was fueling, historic prosperity, a historic bull market. By the late 1990s, I was convinced that we had fundamentally changed finance. That for the first time, unique in history, we had global credit that was unconstrained. That's the quality and the quantity of credit was unrestrained. There was no gold standard. There was no Bretton Woods monetary regime. There was no even ad hoc dollar reserve system that was restraining credit. And unlike historically, when credit was dominated by bank lending, this new credit that developed in the 1990s was market-based. Securitizations, Fannie, Freddie, derivatives, Wall Street finance. I was convinced that credit is unstable. This new market-based credit was going to be highly unstable. So when I started writing my blog back in 1999, I titled it The Credit Bubble Bulletin, but I really believed the bubble part would only be in the title for maybe a year or two. Never did I imagine that I would still be calling my blog The Credit Bubble Bulletin in 2015. Yeah, this has gone on. I actually believed that once policymakers understood what was the transformation in credit and how they were losing control of credit to this new market-based, Wall Street-based credit, that they would rein this in. I had no inkling that instead that they would accommodate this type of credit and use this credit for reflationary policy. And that's how it really got away from them is accommodating financial leveraging, speculation, etc. I never imagined it would get to this point.
Well, a close friend of mine, Richard Duncan, has written extensively, and Richard argues that he believes that capitalism is no longer effectively working and hasn't for some time. And what he argues is we actually are now living in creditism, and that is capitalism was always about savings, and savings being reinvested into productive assets to create real discounted cash flow. Well, today, that's not what's going on. And in fact, we're creating credit for the sake of consumption, and that consumption does not generate, obviously, real cash flow. And so it's only a matter of time before the debt will overpower it. I mean, you just look at last quarter, 90% of, you were mentioning financialization, 90% of all earnings was returned to shareholders either as buybacks or dividends. There's no capital investment there.
Right. And, I have a similar view.
Okay, I was wondering about that.
Yeah, and I fear for capitalism. I'm very much a free market person. I want in the real economy, supply and demand to dictate price. I want the government as much as possible out of it. At the same time, I look at the financial sphere and the real economy sphere. The financial sphere has to be carefully regulated. You cannot have unconstrained credit. You cannot have a financial sphere that inflates at a whim because that distorts the pricing mechanism. And what we've had now are policymakers, especially the Fed, they're dictating their policymaking to inflate the financial sphere and distort the pricing mechanism in a financial sphere, which I don't think capitalism can function well over the long term if you have this type of a policy course. I fear when the crisis collapses, it'll be folks like us and your listeners that are going to have to defend capitalism and say that capitalism wasn't to blame. It was a runaway financial sphere and poor policymaking managing money and credit that was the culprit. One of my favorite economists, Hyman Minsky, he used to argue that capitalism was flawed. And I take exception with this. I don't say capitalism is flawed. I say capitalism has vulnerabilities that we cannot disregard. And that is in the financial end. That is in credit. And I like to think of the analogy that, it's like saying your eyeball is flawed because it's so soft. Well, it's soft because it needs to be soft because of the function that it has. So we know it's soft. So if we go into the hot sun, we're going to have sunglasses. If we go into a steel fabrication plant, we're going to wear safety glasses. And part of the problem is we have disregarded the vulnerabilities in capitalism, and have not separated, the real economy pricing mechanism from the pricing mechanism that works very differently in the financial sphere.
What it's led to is a mispricing of risk, lack of price discovery, tremendous malinvestment right across the board, which says capitalism isn't working effectively, because that's in fact what it delivers. Something's wrong there. But is it forcing investors to take more risk than they really understand they're taking today?
Absolutely. I think very few appreciate the systemic risk that is built up in the system.
Could you help with that?
Sure. In this analysis gets very complex and difficult. To simplify it, we've had central banks. We've had the Federal Reserve since the end of 2007 expand its balance sheet by $3.6 trillion. So basically, it's created debits and credits. It's electronic money and credit that in the marketplace, in the world, we believe there's $3.6 trillion of wealth there. Global central bankers have done similar policies. Unfortunately, they're electronic debits and credits. There's no real wealth there. And at the end of the day, I fear that there's going to be a crisis of confidence in this type of electronic money and credit. Right now, the central banks have the markets under control and are able to dictate, perceptions as far as value. But if there's ever a crisis of confidence in the actual underlying value of this money and credit, then all of a sudden, you have a seizing up of credit. We saw a hint of that in 2008, 2009, and then stock market values come down, corporate debt markets come down. People see their wealth disappear. They quit spending. And then all of a sudden, you have a general decline in asset values in a very, very different environment than today. And today, we have record household net worth. We have record security values. We have record, reflation of the system. So there's this perception that there's endless wealth out there. But I think it's very fragile, and I think that desperate measures, especially since 2012, this age of do whatever it takes central banking, all these financial asset prices are distorted.
You've written extensively over the years about financial fragility. Could you help our listeners with understanding that? Sure.
Credit is powerful, and when we create new credit instruments, they're basically just new IOUs, and it creates new purchasing power. And this purchasing power can be used in the real economy. It can be used to buy stocks and bonds. It can be used to leverage financial instruments. And as long as credit is expanding, and that's why credit is so seductive, as long as credit is expanding, then asset prices, wealth, the economy, things look good, and it looks sustainable. But what's not appreciated is the underlying fragility. And I say fragility, if for some reason we're not able to continue to generate this new credit growth, then you have serious problems, and all of a sudden your asset prices, during these credit booms, and this was especially the case during the 1920s, and I don't think current economists understand the 20s very well. Certainly, I don't believe Ben Bernanke understands the 20s.
The expert.
I think it's a flawed understanding. When you have these credit booms, you inflate price levels. You inflate prices in goods and services. You inflate corporate profits. You inflate asset prices. The problem comes if down the road you can't continue to create that credit, then you can't sustain these elevated price levels. And we saw, it wasn't that long ago, 2008, 2009, we saw this dynamic because all of a sudden the market could not generate significant mortgage credit growth because home prices started to turn down, credit conditions tightened, and all of a sudden mortgage credit stopped in its tracks. The real economy didn't generate sufficient credit to keep levitated corporate profits and incomes up, and you started to see the downward spiral of these price levels. and it's self-reinforcing. The downside of the credit boom can be very difficult, very, very, ugly situation. What we have now is we're, creating all this government debt, all this central bank credit, and that has reflated the system. But at some point, the markets may question the real value of all this money and credit, and then that would, initiate another downside of the credit cycle. And one of the advantages that policymakers had, the 2008 credit crisis was basically a private debt crisis, private mortgage debt. So you put a government stamp on it, made it more government debt essentially, and then the system was able to reflate. We doubled federal debt since the crisis. I mentioned the dramatic rise of the Federal Reserve's balance sheet. During the next crisis, I'm not sure where we get the credit. Does the Fed's balance sheet go to $10 trillion? Do we run $2 trillion federal deficits? So there's a lot of unanswered questions, the next crisis in the markets.
Credit only moves to debt is if somebody can post some collateral or something to pledge something. And right now, Doug, what I'm seeing is a tremendous shortage of collateral. And then with this whole pyramiding of rehypothecation going on, it's a terrifying fact or possibility of if collateral values fall even in the slightest, the run that could begin to happen. My view, just as an aside on this, is that quantitative easing has put so much credit out there that in fact what it did is brought demand forward, and very effective at it. But as soon as demand builds, supply will pick up, and we've had this massive build out in Asia to match that kind of supply, and that goes on with cheap money. But at some point it reaches equilibrium at an elevated level. Now what happens then is you've got to bring more demand forward, which is even tough to do when money's this cheap, but it's significantly more demand to sustain that levels. And then when it doesn't happen, immediately those on the supply start cutting, and the commodity prices plummet, Baltic dry rates plummet, etc., which is a sign that the demand is weak. And then what happens is, at least what I was starting with, is collateral, because a lot of these commodities are posted as collateral, and now we have a real credit problem. Does that pass your common sense, Ted?
Absolutely. That's excellent analysis.
That's a layman's translation.
Yeah, it's very well said. For my framework, and I hope I'm wrong, so I really hope I'm wrong. And I thought the big bubble burst in 2008. In April of 2009, I had to change my tune, and I had to start warning of what I called the global government finance bubble. Mm-hmm. So I was very concerned that the bubble went global. China is a historic bubble. As a credit analyst, I'm in awe of what's unfolded in China over the last 6 years.
Are you worried? Are you worried about it?
Very worried. Very worried.
I echo the same thing.
Very worried. The emerging markets have been a huge bubble for 6 years. And I'll tell you, my analysis says the global bubble has been pierced. I'm looking at commodity prices. I'm looking at the emerging market currencies.
I agree.
And I think the bubble has been pierced. And the way it works, these bubbles get pierced at the periphery, at the edges. And what we've had here, especially over the past year, the cracking of the bubble at the periphery has led all this central bank liquidity to go to the core, which is the U.S. securities markets. And I call it the king dollar dynamic. This is a similar dynamic to what we saw in the late 1990s. Now this global pool of hot money is coming into the dollar. So the dollar is making a parabolic move higher, which is leading hot money to exit commodities and oil, the emerging markets. So I think right now, the system's very fragile. And part of the problem is I think we have enormous amounts of leverage globally in securities markets. So this leverage cannot withstand a decline in securities prices.
Precisely.
So, and I think that's in EM in the emerging markets. I think it's in sovereign debt. It's in stocks. I think there's a huge global carry trade that's short the yen. So we've seen hints of this. In the summer of 2012, I think the global financial system was at the brink of serious trouble. In the spring of 2013, I think the system was under stress again. Each time there was stress, you had these dramatic policy responses. I think we're getting close to the point where policymakers can't really dictate these global flows. Right now, dramatic policy out of Japan and Europe has only led to weaker euro and yen and a stronger dollar that's kind of fed this king dollar dynamic, which is coming at the expense of the global bubble, especially in the emerging markets.
Well, Ambrose Evans Pritchard at the Telegraph in London has been arguing for some time that it leads to my point earlier about demand, supply and demand, is that we have a $9 trillion carry trade of cheap U.S. dollars that's effectively flowed into emerging markets, about $6 trillion of that, to finance a lot of that build out of the he doesn't say it, but the build out of the supply. Now that it's slowing, you have less abilities to pay to service that debt, as cheap as it might be, and all of a sudden you're in a currency that's increasing, and the last thing you want to do at the debt, that is be, the cardinal rule of a carry trade is always borrow in a currency that's going to fall. So suddenly you're in a margin squeeze, and it just leads to itself as a panic of some way covering your exposure, and as the dollar gets strong, it makes your problem worse, and especially if demand, it continues to slow in the emerging markets. Is that a possibility, what's going on here?
Yeah, I believe it's unfolding. And
yes.
Yeah, and
I think the bubble's pierced. I agree fully with you.
And,
but it may take 6, 8 months, a year, or whatever, and more kicking the can down the road to stall it. But at some point, it'll wash over the equity markets.
Right, and I remember when subprime started to crack in the spring of 2007. I didn't imagine that the mortgage finance bubble would continue and it wouldn't really burst until the fourth quarter of 2008. Part of this historic policy response to the 08-09 crisis was this devaluation of the dollar, flooding the system with dollar liquidity. Part of it was this global reflation trade. Everyone could leverage in the emerging markets. They could leverage in commodities. This is all unwinding. And I think the weak link right now in the global financial system is all this dollar-denominated debt. You've had huge amounts of borrowing in the emerging markets, and that's corporations, financial institutions, governments, borrowing in dollars. And now you've had these currency, collapses. You're seeing the ongoing collapse of the Brazilian real, Turkey, South Korea, even more Mexico, Russia, Venezuela, Ukraine. You have a lot of issuers that are not going to be able to service this dollar-denominated debt. There hasn't been a panic because the world is flush with liquidity, but I think it's setting up for a real dislocation as hot money tries to exit and get out of the emerging market. So far, dollar-denominated debt has held up pretty well, but I think that's something we'll watch very closely. Is that EM dollar-denominated debt.
Knowing what's coming, and as evident it is, what should be done?
As an analyst of bubbles, I think it's interesting. I've studied past financial manias, and these manias are not about people running around crazy buying tulip bulbs. These bubbles make it very rational to participate. It's become irrational not to participate in the risk markets, corporate debt, equities, because we get zero return, a negative real return on our savings. I think right now it's time to accept that, take a real risk-averse look at risk markets, hunker down, and just take risk off the table. I've said that in the past, and I've been way too early. But again, I think we agree the global bubble now has cracked, so it's time to really hunker down and just protect what we have and not worry so much about trying to make money.
Well, it reminds me, Doug, I was around in '86 with the crash, 2000 .com, and obviously 2007, but I can remember the fall of 1999 feeling the same, that it was excess of risk, got out of the market. And, of course, the market just kept on going, and I looked really stupid. And it was the spring it finally started to begin to crack in the .com bubble. Even '87, it went on much longer than anybody could imagine. And then when everybody threw in the towel, that's when it hit. So it could just keep on rolling here for some more time, but something's going to happen at some point, I think, my opinion. But don't ever underestimate the central banks and politicians' ability to come up with further schemes to continue to extend things. Whether fair, unfair, regulatories, capital controls, you can be assured there's more to come. Is that a fair judgment?
Again, I fear the Fed's balance sheet is on its way to 10 trillion. I think at this point, anything is possible. And I think, central bankers are desperate. So expect the unexpected, I think, when it comes to policymaking.
Do you expect the Fed to actually follow through with rate increases?
Maybe there'll be a 25 basis point increase if the global markets haven't, come unglued by June. But I think the Fed's balance sheet only gets bigger, and rates stay low unfortunately, for a long, long time.
Yeah, I agree with you. I think the thing to watch is the Fed balance sheet, and I have little doubt in my mind it will be larger this time next year than it is now for some reason, just to keep pumping, and because they're trapped. I think that the central banks are now locked into something they feel they have no choice to do. Doug, we're up against our hard line. It goes so quickly. Closing messages or thoughts you'd like to leave with our listeners?
It's an extraordinary time. It's time to watch developments, pay attention to what's going on globally. And I think we're just entering what will be a fascinating, challenging time for analysis. And I'll do my best to follow developments on a weekly basis. And thank you very much for having me on your show. I much appreciate it.
Doug, could you just remind our listeners how they could find your writings?
Yeah, you can always Google search Doug Noland and stumble across my work, but creditbubblebulletin.blogstop.com.
Must read. I've been following your work, and I can't recommend it enough to everybody. Doug, have a great weekend. Thank you for the time, and we're going to have you back later.
Love to. Thank you very much for your time and this opportunity.
Thank you, and all the best with your new
Thank
activities.
You very much. Bye-bye.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.